The Federal Reserve, or the Fed, controls interest rates. When the Fed cuts rates, it becomes cheaper to borrow money. This can boost the economy. Businesses invest more and consumers spend more. Lower interest rates are like a sale at the store. When things are on sale, people buy more. When interest rates are low, businesses and people borrow more money. Rate cuts can boost the stock market too. Investors get excited about the potential for growth. They buy more stocks and prices go up, but be careful. Rate cuts can also be a sign of a slowing economy. The Fed might cut rates to try and prevent a recession. On September 18, 2024, the Fed cut interest rates. This was the second rate cut this year. The Fed is trying to keep the economy strong. Some people think this rate cut will lead to more growth. Others are worried it might be a sign of trouble ahead. The stock market initially went up on the news. Investors were happy about the rate cut, but the market gave back some of those gains later in the day. Investors are still unsure about the future. It's too early to say for sure what the impact of this rate cut will be. We'll have to wait and see how the economy performs in the coming months. Businesses love low interest rates. It's cheaper for them to borrow money and invest in their operations. This can lead to more hiring and economic growth. Imagine you own a factory. You need a new machine to make more widgets. With lower interest rates, you can afford to buy that machine and expand your business. Lower rates can also boost corporate profits. Companies can refinance their debt at lower rates, saving them money. This extra cash can be used to invest in growth and return to shareholders. However, businesses might be hesitant to invest if they think the economy is weak. They might hold off on big investments until they are more confident about the future. Section 4. Consumer spending spree, more money in your pocket. Lower interest rates mean lower borrowing costs for consumers too. This puts more money in their pockets, which they can then spend or invest. Think about buying a car or a house. Lower interest rates mean lower monthly payments. This makes it easier for people to afford these big purchases. Lower rates can also make credit card debt more manageable. This frees up more money for consumers to spend on other things. But be careful. Don't go on a spending spree just because rates are low. Make sure you can afford the debt before you take on any new loans. Section 5. Real estate heats up. Mortgages get cheaper. The real estate market is very sensitive to interest rate changes. Lower rates mean cheaper mortgages, which can lead to increased demand for housing. When more people can afford to buy a home, prices tend to go up. This can be good news for homeowners, but it can make it harder for first-time buyers to enter the market. Lower rates can also lead to more refinancing activity. Homeowners can save money by refinancing their mortgages at lower rates. However, rising home prices can also be a sign of a housing bubble. This is when prices are rising faster than incomes, making homes unaffordable for many people. Section 6. Stock market. Implications. Riding the wave of lower rates. The stock market loves low interest rates. Lower rates make it cheaper for companies to borrow money and grow their businesses. This can lead to higher profits and stock prices. Lower rates also make bonds less attractive to investors. Bonds are seen as a safer investment than stocks, but they typically offer lower returns. When interest rates are low, investors often move their money from bonds to stocks in search of higher returns. This can create a virtuous cycle where lower rates lead to higher stock prices, which leads to more economic growth, which leads to even higher stock prices. However, the stock market is not always rational. Investors can get carried away by their emotions, leading to bubbles and crashes. It's important to remember that past performance is not necessarily indicative of future results.